Okay, hello everyone, and welcome back. My name is Greg Furman, and this is the Vantage Point AI Market Outlook for the week of February the 26th, 2024. Now, to get started this week, we'll begin where we usually do as of late with the global equity markets. So it's not isolated just to the S&P 500. We can look at them all, but we need to look at true performance, not a rolling performance model here, because again, it's a lagging model that very often can be misleading to the average trader. So what I've done here with the S&P 500 is show the true 5-day performance on the S&P 500, which is a mere 0.55%. Still a good move for a 1 week period, but we must take our anchor points from the start of the week to the end of the week to know exactly what the performance was. If we go back and use a rolling performance model from Thursday to Thursday, Wednesday to Wednesday, we get an inaccurate number of 1.29%. So it's always good to make sure that you're using the beginning of the week and the end of the week as your actual performance for whatever given market it is you're looking at. So when we do that accurate comparison, we can see that the Dow Jones Euro Stock 50 actually did 1.9% on the week, far better than the S&P 500. When we look at this going into next week, our T-cross long 47.47, that's our key support. Our S&P 500 key support will come in at 49.82. So again, we can very quickly identify the positive correlation between the S&P 500 and the Dow Jones Euro Stock 50 and get an accurate performance of both to see which one we actually want to trade in. So our predicted differences are good on both, but clearly the Dow Jones Euro Stock 50 has been the better play. When we look at the DAX, you can see it's up a true 1.72% on that same 5-day period without the rolling performance model, because again, it could indicate that the S&P 500 is a little more bullish than what it actually was, or is more importantly. So when we look at the DAX, our key support for next week, our T-cross long, 17,120. Indicators still look pretty good, but you can see that we are firmly above the monthly and the yearly opening price and the quarterly for that matter on both of these two major indices. When we look at the CAC 40, we have the same setup here. We're using that yearly opening current. And again, if you're using a lagging rolling performance or an inaccurate anchor points and go back a random 30 days or a random 365 days, you would never see this particular level of the current yearly opening, 76.52, our monthly 76.46. Very important that we're looking at this because as we can see, our T-cross long is above both of those key levels at 77.58. This will also help traders with accurate stop loss placement, or again, understanding what true performance really is with the CAC following the DAX. Now, when we come down and look at some of the other indexes, if we look at the FTSE 100, we can see it's a very different setup, only up 0.12% on the week, but this is a different structural picture here. We're above our monthly, but we're still negative on the calendar year on this particular index. So again, there's two ways we can look at this, that there's better potential value here, but you can see that the direct intermarket correlation is nowhere near as strong as what the DAX and the CAC 40 is. So this one being more volatile, but it is slowly turning bullish. We're above our monthly opening price at 75.99, and we're now above our T-cross long at 76.22. When we look at the Russell, we see something very similar price action in the month of February, basically trapped between the current yearly opening price and the current monthly opening price. That's what makes these levels so important. Then we have our T-cross long that's coming in at 2005, which is smack dead in between these two particular levels. So for now, we continue to look for this to rise with the other global indexes, but we can also assess here that the MA diff cross took place right on the current yearly opening price. So again, if you have the wrong anchor points, then you wouldn't even see that yearly opening price at 2043. That's the point, or 2048, excuse me. I want to make sure that I'm stressing that so we can all see it. But that MA diff cross combined with the current yearly opening price, it tells us that if nothing else, we're going to retrace lower. Now we've retaken our T-cross long and it's starting to move up. So I could make the argument that maybe the Russell 2000 is a little undervalued. Maybe that's another place we would look at for next week. But without these proper numbers, that would be very, very difficult to do. The Nikkei 225 up 1.75%, with the European markets also very strong. We're above our monthly opening price, our yearly opening price, and the T-cross long, almost identical to the S&P 500. The Nasdaq looks basically the same way. But again, that Nasdaq performance mirrors the S&P. The true performance is not 1.29%, it's 0.55. The Nasdaq at 0.49% approximately. But it's important that we can see that and understand there's a very, very high correlation to these two, and the European equity markets, a very strong correlation between the DAX, the CAC 40, and even the Nikkei. So with this type of a setup, we can directly see our intermarket correlations, then identify what the real trend is with accurate percentages of those particular moves. When we look at gold, gold does play into a part here, but you can see that structurally gold is trying to turn bullish here. We're holding on the T-cross long at 2022, but we are firmly below our current monthly opening price and our yearly opening price. You can see we've had retracements to that exact level. Again, if you don't have the proper anchor points using the current monthly, quarterly, and yearly opening prices, then you would not see that opportunity to sell at that particular point into that area. So again, we're running sideways here, but I believe gold can retake that 2066 mark, but it is likely not going to be until probably mid-March when we get past this period of dollar strength. And it's very important that I point that out. Now, when we look at the dollar index, you can see what's putting pressure on the dollar index, the equities. Of course, the Fed is, again, can't seem to make up his mind what he's doing. So I wouldn't count on that you know what this Fed is really going to do. But for now, we're holding above the current monthly opening price here. That price coming in at 103.51. We're slightly below our T-cross long. Our predicted differences are short and or medium and long-term crossovers. They did take place over here, but again, the true performance model on the dollar index is we are still bullish on the year. That is an indisputable fact. We're positive on the month and we're positive on the year. When we do a comparative of that to gold, we see something the polar opposite. That's the inverse correlation between the dollar index and gold. But ultimately, I do agree and believe that it will be gold that will go higher, likely with Bitcoin and a few of these other markets. But for now, remember, with the US dollar, the US dollar is not like a stock or a commodity per se. People are required, without an option, to buy and sell certain currencies. Nobody has to buy a stock, nobody has to buy a futures contract, even though they are very popular. But the main point that I will make is, again, is that at the beginning of the month, the U.S. government must pay retirees, government employees, pensioners. There's real demand for something, and even if the dollar is the worst currency in the forex market, in the foreign exchange market, they still must buy those dollars at that time. So I do anticipate further dollar strength going into March after likely a bit further of a pullback, but we remain positive on the month, and that is what is incredibly important to point out here. Now, when we look at Bitcoin in a comparative, Bitcoin is the clear winner in these markets here, guys, is the main thing that I can say. We continue to, once again, advance higher, and I believe we can still go higher. So right now, we're holding along our long predictive, but the yearly and monthly opening prices, and the weekly for that matter, remain bullish. So once again, I'll continue to monitor this. But again, it will be interesting to see which direction we go with Bitcoin for the remainder of the year. But I believe that will be up. So when we apply this, put our T-cross long on our Bitcoin contracts, we can see the T-cross long 49,611. That's still our main support level using the VP software. Our neural index is mixed. Our predicted differences are saying we've got some downside here. I would agree with that to some degree, but I don't think a lot of downside. And as long as we remain above 42,000, Bitcoin still has that very strong possibility of advancing well over the 60,000 mark. And we're only into the mid to late February, guys, and we've already been over 50,000. This has been a great long trade on Bitcoin ever since we first discussed it back in early October. And again on January the 1st, you can see how Bitcoin runs along its yearly opening price and then ultimately breaks higher. So we'll continue to look for further moves of this nature with Bitcoin, but nothing just goes straight up and straight down. A pullback is normal, it's healthy, and it's what we would anticipate. So as long as we know this, we can actually trade it. So from here, let's go look at some currencies. Now, when we look at our main Forex pairs, and I'll also incorporate light sweet crude oil into this, that's a very important part of our trading. And of course, our inverse correlation, the MGA stock, which will tell us when the dollar index is getting ready to reverse. Now, if we look at Magna International stock, the indicators in Vantage Point, the neural nets, they've identified there's a 94% inverse correlation between the dollar index and Magna International stock. This is how powerful intermarket analysis trading is. So when we look at this right now, we can see structurally this stock is very bearish below its yearly opening, monthly opening, and below our T-cross long. I will respectfully submit there's a dual trade here. Not only can we probably around mid-March, mid-April, or early April, not only or sooner, we can buy Magna and sell dollars, but we're looking for Magna MGA to break higher above our T-cross long, that area coming in at 55.34. We break above that, that would trigger dollar weakness. So again, this weakness in the dollar by some of the pundits out there, I don't think they're looking at everything they should be looking at, because you can't say the dollar is bearish when it's positive on the month and it's positive on the year. Just like I can't say that Magna is bullish if it's negative on the year, negative on the month, and below our T-cross long. There's a structural bias that we can build into every single market with this particular strategy. Now, there is some life showing here in MGA, but I believe it's temporary. But either way, if we move above our T-cross long, that would be the trigger point we're looking for the dollar to sell off. So our predicted differences are saying a little bit more downside in the dollar, but we need to get past that first part, the first 7 days in March, where it's a period of known dollar strength. So if we do that comparative analysis, and first of all, we need to identify that there's a very strong positive correlation between light sweet crude oil and the dollar. Now, there are two main seasonal patterns that I can tell you about with light sweet crude oil. The first one is the correlation to the US dollar index, the period of known dollar strength between late January and late March, mid-March. Then you have a secondary real seasonal pattern that's strictly based on oil. That's usually between mid-April to mid-July. So for now, oil remains structurally strong. We're above our yearly opening price at 71.78 and our monthly opening price at 75.90. We're holding just barely above our T-cross long, 76.54. But if there's a bias for a higher dollar, there's bias for higher oil contracts. That is the theory based on intermarket correlations. But again, we have some weakness that is forming with our MA diff cross, but we just can't seem to push below the monthly opening of the T cross long, so it identifies a critical area. So again, if that dollar remains strong, then our oil contracts would do the same, but either way, we would be long oil while above 71.78. Now, as we break this down into some of our main Forex pairs, to simplify it, we first and foremost look at the split screen with our core indicators, and this is warning of yet again a move to the downside, believe it or not, on Euro US. The pink line crossing the blue line is the medium-term trend weakening against the longer-term trend. So when we look at the structural bias of this accurately, not with a rolling performance model, because again, lagging and misleading, you have to be, I'm not saying you can't use it, I'm just identifying by using that S&P 500 how misleading that actually is with the true performance model. So right now, our yearly opening price 110.38. There's very little reason to buy the euro currency just yet, but I do believe the euro will do better than the dollar this year, just not in this particular time frame between now and mid-March. Then we would target the euro once we hear a little bit more from the ECB. But there is we can call it a corrective move, or we can say the primary trend is likely to continue with that MA diff cross. So again, our T cross long there is coming in at 107.99. That is your focal point for next week, whether we're staying above or below, let's just call it the 108 level. So again, if we're holding above 108 for the week, then we would see the euro rise. But if we're holding below 108, then shorts are back on the table. And that's the easy way to look at it. And then when we see that particular MA diff cross turning lower, I believe that is a warning sign of pending dollar strength. So if that's the case, then we would see the US Swiss franc potentially move towards one of its, I would argue, potentially final moves to the upside this year, potentially. The dollar has not done well against the Swiss franc at all. So what we're looking at right now is the structure of this particular currency pair, the correlation, first of all, to the dollar index. Secondly, right now it remains positive above its monthly at 86.14 and its yearly at 84.10. This structure makes it very easy for us to see where those main problem areas are or potential buying areas with our T-cross long at 87.63. So again, firmly up on the month, firmly up on the year, but we're struggling along this T-cross long. That is the deciding level for the week, 87.63. If we're holding below it, there's a sell. If we're holding above it, there's a buy. That's the way we look at it. But again, this is an outlook, not a recap of something that's happened weeks ago or even months ago. We're talking about real trading next week. So these are the levels that you want to watch. Now, the British pound US dollar next week will be an interesting one because it's challenging these exact levels, the yearly and the monthly opening price. They're coming in approximately on the monthly, we're looking at 126.88, and on the yearly, we are looking at 127.32. So I believe it will struggle to get through these areas only because of where we're at. Or in the alternative, there will be a false break above the yearly opening price only to violently retreat mid to late week as we move into this period of known dollar strength at the beginning of March. So, but this structurally, whether if you're a cable bear, then but sorry, by cable I mean the British pound. It's probably been a while since anybody used that terminology since the war, but I still call it cable. So when we look at this, we can say, okay, if you're a short seller, then this area around there is very good. The predicted high for Monday, 127.08. That's a reasonable short trade. But again, our predicted differences are moving above the zero line, and that is warning of some strength here. But very, very often before the dollar goes into its period of known strength, it usually weakens first. So again, be careful with this one, but as long as you know these levels, and of course the very important T-cross long at 126.34, then either way, I think we do have a buy on this pair. I just question whether it would be this coming week or in the next couple of weeks, because again, we've got to turn positive. I could make the argument, many people could make the argument, that the British pound US dollar is very bullish right now. Looking at the MA diff cross, we're getting above our T cross long, but again, then they implement a rolling performance model and they don't look at the current yearly or monthly opening price and they miss this. So again, you can use it, not use it, but I simply want to draw your attention to it because there's already been multiple fantastic trades off of this level this year already. Now, the dollar yen continues to advance, and I will continue to advise caution. I believe the Bank of Japan is not going to tolerate much more of this. I believe they're going to look for, they're going to leverage the Fed, the inevitable Fed rate cut. The Bank of Japan will likely target their intervention around that time to get the biggest bang for the buck. But the Fed is going to have to cut at least 4 times, 3, 4 times to change the carry trade. The interest rate differential between the Bank of Japan and the FOMC, that needs to change dramatically to get rid of this carry trade, and that's going to take some time. So I think it's still going to hold up at these levels, but be very cautious. The T-cross long, 149.56. As this pair moves up, so does the T-cross long. And I believe it's just a matter of time before it breaks down below it. But when it does, it could get very, very ugly very quick to the downside. And I do believe the Bank of Japan will try and leverage any dovish statements from the Fed. I believe the Bank of Japan is on the prowl looking for that. Or I could even go out on a limb and say that is it possible that these two are working together at some point? Well, I don't think it can be something that can be ruled out. You do this, I'll do that. Well, I guess we'll see. Either way, we're not seeing a lot of buying off this most recent verified resistance high at 150.88. The market is completely stalled up here. The only thing, in my respectful opinion, only that could push this significantly higher is for the Fed to say there isn't going to be a cut, and that would the carry trade is back on in full steam. So for now, that's your key level for 149.46. If you're going to be long up here, guys, you need to be holding above that particular level. Now, the US Canadian pair, once again, usually the Canadian dollar starts to do better into April with that oil correlation, equities moving higher, but it really has flatlined on that softer CPI number. I believe the Bank of Canada is going to cut probably at the next, if not at the next meeting, the meeting after, guys. The CPI is not hot here in Canada at all. So the key T-cross long there. That's coming in at 134.83. That's our pivot level for the week. We're holding below it, we're selling. We're holding above it, we're buying. It breaks it down in a very simplistic term. Right now, the structural bias of this is bullish, saying more upside. I believe that to have some degree of accuracy. Our monthly opening coming in at 134.35. Our yearly, though, 132.50. I can all but guarantee you that we are going to retest that level in the coming months, if not the coming weeks. So, but I think it's going to really struggle at that level given the current economic environment here in Canada, the political situation. I believe there could be an election called sooner rather than later. We'll see how all of this plays out, but for now, the monthly opening for the remainder of this calendar month, that monthly opening price, 134.35. Equity stays strong, oil stays strong, that the dollar stays strong, believe it or not, will actually help the Canadian dollar. But these are the key levels we're looking at. The indicators on Vantage Point, dead flat are predicted differences on the zero line, so be cautious with this one. Now, with our Aussie and our Kiwi, once again, the Aussie is trying to turn positive on the month, but it is just struggling all along here the entire week. There's just no buyers. The interesting part of this is that if we do get buyers coming in, we should get to 68.12 relatively quickly, but we have to get through this area. And again, you're coming into a period of known dollar strength. The equity markets, the S&P 500, very high correlation. The Aussie and the Kiwi have a high correlation to both the S&P 500 and gold. So again, the S&P is nowhere near as strong as what you're led to believe here, and gold is not either. So again, my optimism on further upside for these next week or two remains heavily guarded on both the Aussie and of course the Kiwi, basically the same trade. And I would respectfully submit to have a look at the Aussie-New Zealand pair. It's a good way to trade both the Aussie and the New Zealand against each other without being subjected to the dollar strength and weakness is one of the ways I would say that. But the Kiwi right now is the stronger of the two. We've got a clean break of the monthly opening price, and we've got a clean break of our T-cross long, that level coming in at 61.44. But again, I would respectfully submit The Aussie New Zealand is the culprit here. They're selling Aussie New Zealand. So when they do that, they have to sell Aussie US and buy New Zealand US. So that the Kiwi is the stronger of the two, but also remains firmly below its yearly opening price at 63.18. So likely a little bit of choppiness going into the end of the month, but also some very good opportunity. So with that said, this is the VantagePoint AI Market Outlook for the week of March the 26th, 2020.